I think the third quarter for the markets business was overall reasonable. Many of the markets still have very low volatility, such as certain parts of the foreign exchange market. Overall, on a dollar basis, the U.S. Investment bank's markets business were up roughly 6%, as were we. So again, we stayed in line with the U.S. banks. We did particularly well in the fixed income and the credit space. So it was a good quarter, all things considered, for us. But we do look forward to a little bit more volatility in the markets down the road.
Jes, good morning to you. Look, I've just been drawn to this very robust, but not as good as the third quarter last year, return on tangible equity from Barclays UK as well, way outperforming the CIB and Barclays International. Can I assume from this that Brexit is a little bit of a red herring if you're turning in between 17 and 19% ROTE from your UK business?
For sure, it's still a very profitable business for us. We have a strong UK credit card business, which delivers strong returns, and impairments have been reasonably manageable. We were able to actually slightly improve our net interest margin up to 310 basis points. We increased our balances in our mortgage portfolio. So whilst there are some headwinds, we had a reasonably good quarter, and obviously the profitability is quite acceptable. But recognize, even with Brexit, we're still in a pretty benign credit market for the UK. And we have a very high beta exposure to the UK economy and need to keep our eye on it. We have been quite prudent in our extension of unsecured consumer lending, but we like the profitability that we've been able to generate. A lot of it is being driven by digitizing our finance. The Barclays app now has got 8.5 million consumers going on it every day. It was voted the #1 banking app service in the UK. So bringing technology to our UK consumer business has been able to allow us to preserve the profitability of that business.
And look, I've talked to you about this many times, but your net interest margin, it is under pressure. You lost 14 basis points on it, but it's still 3.1%. And just for our viewers' reference, yesterday RBS came in at 1.97%. I know they've got a different business mix. But my point here is, regardless of what I'm sure your friend Mark Carney does as well, the fact of the matter is there are still fat margins to be had out of banking. Do you think journalists, do you think the analysts, do you think the market is too obsessed with the central banks? And I say that because we've got base rates below 1% in the United Kingdom, and yet you're still turning in a 3.1% NIM.
I think there are a couple of things. First and foremost, it is the mix of business. We have one of the largest unsecured consumer credit card portfolios, and that will generate a higher net interest margin for sure than a secured mortgage portfolio will, for instance. But I also think the large banks in times of uncertainty do quite well in terms of customers' trust, leaving money on deposit with you. And also the UK consumer has actually been putting more and more in cash, I think, as a cautionary move to the uncertainty around Brexit. But obviously we enjoy a strong net interest margin, but it is under pressure, and I think it's going to continue to be under pressure for a number of quarters to come.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.